Welcome to the week that was. We're diving straight into, well, a really wild period, October 6th to 11th. It packed in two completely opposite stories, didn't it? First, this amazing new all-time high for Bitcoin,
Absolutely triumphant.
followed almost immediately by one of the most violent, historic flash crashes we've seen. If you were watching the charts last week, you definitely felt the whiplash.
Oh, absolutely. It was the ultimate stress test for the market.
Yeah.
And look, our goal here today is really to sift through that chaos. We need to try and separate the, let's call it noise, the short-term swings driven by crazy leverage, maybe a geopolitical shock
Right.
from the underlying signal. And that signal, I think, is still clearly one of accelerating institutional adoption, even through all this volatility.
So Bitcoin hits a new peak, absorbs huge profit taking, survives this massive liquidation event all in a few days. That's the story we need to unpack.
Exactly. It navigated all that, and somehow the deeper structural adoption just kept going.
Okay, let's start at the beginning then. The ascent. Early in the week, October 6th, 7th timeframe, Bitcoin it skyrocketed.
It did. Blew past $125,000.
Right.
Peaked just over $126,250, roughly. We were in totally new territory, pure price discovery.
And what was lighting the fire under it? There was that macro backdrop, right? The U.S. government shutdown was still dragging on.
Yeah, entering its second week. And that really, it solidified Bitcoin's narrative, didn't it? As this non-sovereign safe haven asset. People were looking for places to hide from potential currency debasement. It accelerated that whole debasement trade.
Which just quickly is basically investors moving away from traditional currencies, fearing governments might print more money or lose stability, and looking for assets outside that system.
Precisely. And you saw it play out perfectly. It wasn't just Bitcoin. Gold also surged, hit a new record high itself, over $3,900 an ounce. So the market was clearly saying, okay, non-sovereign stores of value look attractive right now.
But this cycle, the story always comes back to who is buying. It felt very different this time, very institutional.
Oh, it's an institutional tsunami, no question. Look at the spot Bitcoin ETFs in the U.S. In that 1 week leading up to October 6th, they pulled in over $3.2 billion in net inflows. Just enormous.
$0.2 billion in a week.
And then, get this, on October 7th alone, one single day, the combined net inflows hit $1.21 billion. BlackRock's IBIT fund accounted for almost $1 billion of that, like $967 million itself.
Wow.
That's not retail FOMO. That's strategic, almost price inelastic buying. Big players deciding they need exposure, regardless of the day's price.
That scale of institutional commitment is just, well, undeniable. But, as the price was soaring, we both know this market loves to punish complacency. Was there a hidden risk building up under the surface?
Absolutely. And it was flashing neon red in the derivatives market.
Right.
While spot buying was strong, the leverage is building dangerously.
Yeah.
Derivatives open interest, that's the total value of outstanding futures and options contract.
Right, the leveraged bets.
Exactly. It surged to a record high of $75 billion by October 7th. That is an extreme amount of leverage concentrated in the system.
$75 billion. So what does that actually mean for market stability when you have that much leverage sloshing around?
It means the market was basically primed for a fall. It was structurally vulnerable. All that long side leverage created the perfect setup for what we call a long squeeze.
Okay.
So a relatively small price drop could trigger forced selling from those leveraged longs, which pushes the price down further, triggering more liquidations, and you get this cascading effect. It was just a matter of time before something sparked it.
Okay, so the derivatives market was a powder keg waiting for a match. But while that fuse was burning, the underlying sort of structural adoption story didn't stop. Even as prices consolidated between October 8th and 10th, we saw some major moves.
We really did. The structural bid just kept getting deeper. The biggest headline, I think, from that period was on the sovereign front. Luxembourg's Intergenerational Sovereign Wealth Fund, the FSIL.
Right?
They formally announced they were allocating 1% of their total holdings to spot Bitcoin ETFs.
1%. Now, that might not sound huge, but coming from a sovereign wealth fund, especially in the Eurozone, that feels significant. Why is that such a big deal for, say, a pension fund manager elsewhere in Europe?
It's absolutely massive because it provides immediate, political, and, crucially, fiduciary cover. For years, the biggest hurdle for big conservative institutions like pension funds has been career risk.
Being the first one to step out of line.
Exactly. The fear of being blamed if this volatile new asset class drops. But when a state-level fund like Luxembourg's FSIL makes a move, it signals a level of acceptance. It drastically reduces that career risk for every other fiduciary manager who's been sitting on the sidelines. They now have a precedent, a justification to follow.
Okay, so political cover is key. And meanwhile, the ETF machine just kept grinding, right? Taking Bitcoin off the market.
Kept grinding away. BlackRock's IBIT, as we mentioned, crossed 800,000 BTC in assets under management. Just stop and think about that number.
It's huge.
One fund now holds 3.8% of all the Bitcoin that can ever exist. This isn't day trading. This is structural, long-term absorption. That supply is likely locked away for a very long time, maybe forever.
And we saw interesting things on the corporate treasury side, too. Strategy Inc., the biggest corporate holder, they actually paused their buying for about a week there, end of Sept to early Oct. But the corporate interest didn't just vanish.
No, it just got more sophisticated, more diverse. We're seeing new models emerge. Like NetBrands Core announced this plan for a layered treasury. They're not just going to buy and hold BTC.
What do you mean by layered?
Well, they plan to use the yield generated from staked assets like Ethereum and AV within the DeFi ecosystem to then systematically buy and compound their core Bitcoin holdings. So they're using DeFi mechanics to enhance their Bitcoin strategy.
That's a really interesting evolution. It's not just digital gold anymore. It's becoming an integrated part of a broader digital asset strategy. And there were some other big corporate commitments too, right?
Huge commitments. GUI Holdings announced this phased plan to acquire up to $1 billion in cryptocurrencies, starting with Bitcoin, expected within weeks. And ZOOZ Power picked up another 329 BTC, pushing their total over 854 BTC, worth well over $100 million. That signals real corporate conviction, looking past the day-to-day price swings.
But maybe the most, future-looking signal that week was traditional finance, TradFi, starting to integrate directly with decentralized finance, DeFi.
This, I think, is the really big story longer term. Intercontinental Exchange, ICE, that's the parent company of the New York Stock Exchange.
Right, the NYSE.
They announced a strategic investment of up to $2 billion in Polymarket, which is a decentralized prediction market platform.
$2 billion from the NYSE's parent into a DeFi protocol. That's not insignificant. And they specifically mentioned it was focused on future tokenization initiatives.
It's a massive validation. It's not just about acknowledging Bitcoin as an asset anymore. It's about recognizing and actually investing in the underlying infrastructure, the public blockchain rails that will power the future of finance, like tokenized assets. It shows the world's biggest players aren't just watching crypto, they're actively building on top of Web3 now.
Okay, so we've got ATHs, sovereign funds buying in, BlackRock vacuuming up supply, corporates getting smarter, even the NYSE's parent jumping into DeFi. It really felt like things were unstoppable.
It did.
But then came October 11th, and the market got a brutal reminder of just how sensitive it still is to global events, to macro shocks. What was the trigger for that spectacular collapse?
Yeah, that perfect storm we talked about finally got its spark. It was a major geopolitical shock. On Friday, President Trump posted on Truth Social announcing a plan to slap an additional 100% tariff on all Chinese imports.
100% tariff.
Starting November 1st, 2025. That just instantly injected massive uncertainty into global financial markets. Risk off immediately.
And the reaction in Bitcoin was just immediate and brutal. It just fell off a cliff, didn't it? Dropped from over $122,000 down to lows somewhere between, $101,000 and $104,500. Lowest level since June.
It was the deleveraging event we suspected was possible, given the buildup. That crash triggered the single largest liquidation event in crypto history. Our data shows approximately $19.1 billion in total positions were liquidated across exchanges in just 24 hours.
$19.1 billion. That number is just staggering. A $19 billion wipeout in a day. Now, given all the talk about institutional money coming in, was this just retail traders getting wiped out, or were institutions caught in that leverage trap too?
Well, look at the breakdown. Of that $19.1 billion, the overwhelming majority, $16.7 billion, was long positions being liquidated.
So people betting the price would go up.
Exactly. And the sheer size points directly back to that institutional over-leverage we saw building during the rally. The Trump tariff news was the catalyst, the spark, but the dry powder, the fuel for that fire, was the excessive institutional risk-taking from earlier in the week.
So that massive deleveraging completely changes the short-term technical picture then. We stabilized, around $113,000? Where does that leave us now?
It totally resets things. Right now, the market's main job is to defend that critical support zone, roughly $101,000 to $107,000. That's the key area to watch. For any real recovery to take hold, we need to see price reclaim the $117,000 to $120,000 area. But, the positive spin, if you can call it that, is that the market did successfully purge that excess leverage. Painful, but perhaps necessary.
What's maybe most fascinating, though, is how the structural adoption seemed to just continue, almost ignoring that $19 billion crater. It felt like traditional finance looked right past the short-term chaos.
That's the real sign of maturity, isn't it? That decoupling. Look at Morgan Stanley. Right after the crash, literally in the midst of that volatility, their global investment committee issued formal guidance.
What did they say?
They recommended clients allocate up to 4% of their opportunistic growth portfolios, specifically to digital assets. And, importantly, they also removed restrictions for all their wealth management clients to access crypto fund investments, starting October 15th.
Wow. So a top-tier bank like Morgan Stanley putting out a formal recommendation like that right after a historic crash, that's a huge statement about normalization, isn't it? Making digital assets a core part of portfolio strategy.
It's monumental.
Yeah.
And while Morgan Stanley was advising clients on allocating to assets, you had this other group, a consortium of 10 huge systemically important banks, think Goldman Sachs, Bank of America, UBS.
The giants.
They announced they're working together on a joint initiative to create a G7-backed stablecoin.
So they're not just buying crypto assets through ETFs anymore. They're actually planning to build the future settlement infrastructure for institutional money using a blockchain technology.
That's exactly it. It's a profound validation of public blockchains as the fundamental rails for the coming tokenized economy. It's a much deeper, stickier commitment than just ETF flows. It's them building the actual plumbing.
And we saw some movement on the regulatory side, too, providing more clarity, which presumably helps these big players feel more comfortable. FinCEN in the U.S. issued new guidance.
Yeah, clarifying and updating Bank Secrecy Act rules for banks dealing with digital assets. It sounds dry, but it's crucial. It helps reduce compliance friction, remove some of the regulatory ambiguity that might have held banks back, makes it easier for them to engage safely.
And over in the UK, the Financial Conduct Authority, the FCA, they lifted their ban on crypto ETNs for retail investors.
Yes, after 4 years. They lifted the ban on the sale and marketing of crypto-based exchange-traded notes to retail. That opens up another regulated pathway for capital to flow in a major financial center.
And we even saw movement in Africa with Kenya's VASP bill moving forward.
Right? Establishing a licensing framework that aligns with global anti-money laundering standards, the FATF standards. It's all part of this global trend towards clearer, more harmonized regulation. The landscape is becoming more predictable.
Okay, so wrapping up this truly roller coaster week, the big picture seems clear. The market's fundamental strength, driven by that deep institutional demand, is undeniable.
Absolutely.
But tactically, in the short term, it's still fragile. It's vulnerable to that excess leverage building up and obviously to unpredictable geopolitical shocks.
That's the tension right now. So looking ahead, what should you be watching? Well, first, keep an eye on those spot ETF flows. Do institutions keep buying this dip? That'll show conviction. Second, can the market defend that $107,000 support level? That's technically crucial. And third, of course, any developments around the U.S. government shutdown situation remain important.
We've covered so much structural change this week. ETFs, banks getting involved, regulations solidifying, that huge deleveraging. But just as a final thought, looking further out, what's the kind of long-term challenge or threat that maybe isn't getting enough attention right now?
Well, there's something mentioned in some recent Federal Reserve research that's worth thinking about. It's this long-horizon security threat called the Harvest Now, Decrypt Later attack.
Harvest now, decrypt later. What's that?
The idea is because the blockchain is immutable, right? The transaction history is permanent. Malicious actors could theoretically be harvesting encrypted blockchain data today, then years down the line, when powerful quantum computers become available.
They could potentially break the current cryptography.
Exactly. They could potentially decrypt the private keys associated with older transactions, especially on addresses that haven't adopted newer security standards, and steal funds. It raises this really critical long-term question. Can the crypto industry upgrade its fundamental security protocols fast enough to stay ahead of the advancements in quantum computing?
So a race between cryptographic security and quantum power.
It's a long-term race, yeah. Definitely something for you to mull over as you wrap up your week.